This is a PlayStation 5. It is a marvel of modern engineering, a portal to incredible digital worlds that has sold nearly 80 million units since its launch in late 2020. But the real story isn't the plastic shell. It's the silicon heart that beats inside. This chip, a custom-designed system-on-a-chip, is made by Advanced Micro Devices, or AMD. It's a testament to their engineering prowess, combining a powerful CPU and GPU into a single efficient package. But this chip also represents a promise, a massive, multi-year, multi-billion-dollar commitment to Sony. And that promise is part of a much larger story. To understand why AMD, a company that has achieved one of the greatest comebacks in tech history, consistently struggles to beat this company, Nvidia, in the high-stakes war for graphics supremacy, you can't just look at the chips. You have to look at the battlefield. This isn't a story about one war. It's a story about a company fighting three at once, and how its greatest strength, its diversity, may also be its biggest weakness. In the hyper-competitive world of semiconductors, corporate strategy is not just about innovation, it's about survival. It's about choosing which battles to fight, which hills to defend, and where to concentrate your forces. For Advanced Micro Devices, the choice was never that simple. Forged in the crucible of competition, AMD's modern identity has been shaped by a strategic necessity to wage war on three distinct and demanding fronts simultaneously. Each front has its own titan, its own history of conflict, and its own existential stakes. Understanding these three wars is the key to understanding the entire company. This is AMD's oldest and most fundamental conflict. For the better part of 50 years, the battle against Intel wasn't for market leadership or technological dominance. It was a desperate, often brutal fight for corporate survival. Founded in 1969, AMD began its life in the shadow of the industry giant, initially serving as a second-source supplier, manufacturing licensed copies or clones of Intel's microchips. It was a business model built on providing a cheaper alternative, not a better one. This dynamic defined the relationship for decades. Intel, with its colossal brand, deep pockets, and manufacturing prowess, set the pace. AMD followed, consistently pushing the boundaries with competitive pricing, but rarely seizing the innovation crown. There were brief moments of glory, like in the early 2000s with the powerful Athlon and Opteron processors, but these were exceptions to a long and painful rule. The conflict reached its nadir in the period analysts and enthusiasts now refer to as the Dark Ages. From roughly 2010 to 2015, AMD was handedly beaten by Intel by most legitimate metrics. The company's bulldozer CPU architecture was a strategic and commercial disaster. It failed to innovate, instead choosing to simply pile on more processing cores that delivered underwhelming real-world performance. Intel, meanwhile, surged ahead, leaving AMD in the dust. The company was bleeding money, losing market share, and teetering on the edge of irrelevance. But then came the revolution. Under the leadership of Dr. Lisa Su, who took the helm as CEO in 2014, AMD went back to the drawing board. On March 2, 2017, the company launched a product that would not just change its own fortunes, but reshape the entire industry, the Zen architecture. Zen wasn't an incremental improvement, it was a quantum leap. The new microarchitecture delivered a staggering 52% improvement in instructions per clock cycle over the failed bulldozer design. The first consumer products built on this architecture, the Ryzen CPUs, shocked the market. For the first time in over a decade, AMD had a product that didn't just compete with Intel on price, but often surpassed it in performance, especially in multi-threaded workloads crucial for content creators and professionals. The comeback was immediate and dramatic. In the fourth quarter of 2016, just before Zen's launch, Intel commanded a near-monopolistic 81.9% of the consumer CPU market, while AMD held a meager 18.1%. By 2025, that landscape has been completely redrawn. AMD has clawed its way back, capturing a record 27.2% of the lucrative server market and 28% of the desktop market. The data center, once Intel's impenetrable fortress with nearly 100% market share, has become the primary battleground. AMD's EPYC server processors, built on the Zen architecture, offered more cores and better performance per dollar, and the world's largest cloud providers took notice. Analysts now project that by 2025, AMD's share of server CPU revenue will grow to about 36%, while Intel's is expected to fall to around 55%. This war is, and always has been, existential for AMD. Winning here is non-negotiable, and the Zen CPU roadmap is the company's crown jewel. It is the front line that must be held at all costs. While AMD was fighting for its life against Intel, a second war was raging on a different front. This battle for control of the graphics processing unit (GPU) market began in earnest with AMD's acquisition of the pioneering graphics card company ATI in 2006 for a hefty $5.4 billion. In the early 2000s, ATI and its primary rival, Nvidia, were locked in a fierce back and forth, trading blows for the performance crown with each new product generation. But in the years since the acquisition, that competitive balance has been shattered. The story of the modern GPU war is one of a widening chasm. While AMD's Radeon GPUs, built on their RDNA architecture, often deliver excellent performance for their price, particularly in the budget and mid-range segments, Nvidia has established an unprecedented and seemingly unshakable dominance over the market as a whole. The numbers are crushing. According to the industry tracking firm John Peddy Research, JPR, in the second quarter of 2025, Nvidia's share of the discrete, add-in graphics card market reached an all-time high of 94%. This left AMD with a worrying 6%. This represents a catastrophic collapse from the 12% share AMD held just 1 year prior, and it's a far cry from the more competitive 35% share it commanded as recently as mid-2018. This stark contrast between AMD's triumphant resurgence in the CPU market and its near-total collapse in the GPU market forms the central question of this analysis. How can a company be so successful on one front and so thoroughly outmaneuvered on another? Why does this performance gap exist and continue to widen, even when AMD's engineers produce competitive hardware? The answer, as we will see, lies in the immense resources demanded by the other two wars. The third front is perhaps the most unique and strategically the most complex. It's a war AMD chose to fight, and one it has unequivocally won. This is the battle to supply the silicon that powers the world's video game consoles. This is AMD's semi-custom business. Instead of selling off-the-shelf components, AMD engages in deep, multi-year collaborations with partners like Sony and Microsoft. Together, they design and manufacture bespoke system-on-a-chip (SoC) solutions, highly integrated processors that combine CPU and GPU cores tailored to the specific needs of a console. This business model was the driving force behind the PlayStation 4, the Xbox One, and now the current generation of the PlayStation 5 and the Xbox Series X and S. From a business perspective, this was a strategic masterstroke. It provides AMD with a massive, reliable, multi-year revenue stream that acts as a financial cushion against the notorious volatility of the PC components market. In 2024 alone, AMD's gaming segment, which is overwhelmingly comprised of this semi-custom business, generated $2.6 billion in revenue. During the dark ages of the CPU war, when the company was on the brink of collapse, the steady income from the PS4 and Xbox One contracts arguably saved the company from bankruptcy. But this victory comes with a hidden cost. These are, by nature, lower margin deals compared to the lucrative high-end server CPUs or flagship consumer GPUs. More importantly, they represent a colossal and long-term commitment of engineering talent and research and development resources. Servicing two of the most demanding technology companies on the planet is no small feat. This isn't just about selling chips. It's a deep partnership that requires a dedicated front, tying up some of the company's best and brightest minds for years at a time. The very success that AMD achieved with its Zen architecture is what created the strategic dilemma it now faces. Before Zen, AMD was in a desperate fight for survival. Its research and development efforts were conducted on what could be described as a shoestring budget. In that environment, the console business wasn't a choice among equals. It was a lifeline. But the stunning success of the Ryzen and EPYC processors changed everything. It dramatically increased the company's revenue and profitability, which in turn funded a massive surge in R&D spending, from just under $1 billion in 2015 to over $6.4 billion in 2024. This newfound wealth, however, did not free up resources to overwhelm Nvidia in the GPU war. Instead, it escalated the CPU war. Intel, awakened from its slumber, responded aggressively. The data center market transformed into a multi-billion-dollar prize fight where every percentage point of market share was worth a fortune. The very success in the CPU war cemented it as AMD's absolute top priority. This ensured that any new R&D funds would be primarily allocated to defending and expanding that critical beachhead, leaving the GPU division to fight with what was left over. Simultaneously, the console business acts as a talent sink. Designing a custom SoC for a machine like the PlayStation 5 is an incredibly complex task. It demands deep, sustained collaboration and requires the absolute best engineers the company has to offer. These are specialists in creating power-efficient, high-performance designs that integrate CPU and GPU technology, precisely the skills needed to design the next generation of world-beating Radeon graphics cards. Every engineering hour spent meticulously optimizing a chip for the specific thermal and power constraints of a game console is an hour not spent designing the flagship Radeon RX 9900 XTX to take on Nvidia's best. This creates a hidden R&D cost that never appears on a balance sheet, an opportunity cost of talent allocation. It helps explain why AMD's GPU architectures can sometimes feel a generation behind or lack the feature polish and robust software ecosystem of their rivals' offerings. In modern technological warfare, victory is often determined not on the battlefield of marketing, but in the quiet laboratories of research and development. The company that can invest more, innovate faster, and attract the best engineering talent almost always wins. To understand the strategic imbalance between AMD and Nvidia, one must look at their war chests. The raw numbers tell a stark story. Over the past decade, AMD has impressively grown its commitment to R&D, a direct result of the financial success of its Zen architecture. In 2015, the company spent $947 million on research and development. By 2024, that figure had ballooned to an estimated $6.46 billion, a nearly seven-fold increase. But in that same period, Nvidia's R&D spending grew even more explosively. Starting from a higher base of $1.36 billion in 2015, Nvidia's annual R&D expenditure is projected to reach a staggering $12.91 billion for its 2025 fiscal year. In absolute terms, Nvidia now outspends AMD on R&D by a factor of 2 to 1. This spending gap is the quantitative backbone of our entire argument. But the raw dollar amount only tells part of the story. The true strategic dilemma becomes clear when you consider how that money is spent. AMD's roughly $6.5 billion budget is substantial, but it must be partitioned. As one analyst observed, AMD's smaller budget is spread across GPUs, CPUs, AI, and FPGA chips. It is a war chest that must supply three separate armies fighting three different wars. In stark contrast, Nvidia's entire $13 billion war chest is aimed at a single unified target: accelerated computing. Their corporate strategy is a full-stack, next-generation GPU, CPU, and networking architecture, all centered on the GPU and its applications. This is the master of one strategy. Every dollar, every engineer, every research project is dedicated to widening its lead in a single domain. A deeper look at the financials reveals an even more telling strategic reality. By analyzing R&D spending not just in absolute terms, but as a percentage of total revenue, we can see the immense pressure each company is under. This table reveals a crucial dynamic. For AMD, R&D as a percentage of revenue is consistently high, hovering between 20% and 26%. This indicates that the company is spending every dollar it can just to keep pace across its multiple fronts. It is a sign of intense, relentless competitive pressure. They are running as fast as they can, simply to stay in the race. For Nvidia, the story is the opposite. While their absolute R&D spending has skyrocketed, as a percentage of revenue, it has plummeted, from over 27% in fiscal 2023 to under 10% in 2025. This doesn't mean they are investing less. It means their revenue, driven by the historic AI boom, is growing so astronomically fast that their massive R&D budget is becoming a smaller and smaller part of their overall cost structure. This gives them incredible operating leverage and financial flexibility that AMD simply cannot match. This R&D spending gap translates directly into a rate of innovation gap. Research and development isn't just about designing the next chip's physical layout. It's a vast and complex process that includes creating the software that makes the hardware useful, drivers, compilers, and entire libraries of code. It involves fundamental research into new computer architectures, and crucially, it involves building and nurturing a global ecosystem of developers and partners. Nvidia's focused, larger budget allows it to field massive, dedicated teams for each of these areas, all singularly focused on the GPU. They can fund sprawling initiatives like their CUDA X libraries, the Nsight suite of developer tools, and deep partnerships with thousands of university researchers and enterprise developers. AMD's budget, by necessity, must be split. The CPU team requires immense resources to design the next-generation Zen 6 architecture. The semi-custom team needs a dedicated budget to fulfill its obligations for the next Xbox and PlayStation. The GPU team gets what's left. This resource constraint limits their ability to build the deep, feature-rich software stack and broad ecosystem that must surround the hardware to make it truly competitive at the high end. It leads directly to a situation where, even if AMD produces a graphics card that is competitive in raw gaming performance, a measure known as rasterization, it often lags in the robust software features, like mature AI-driven upscaling, DLSS, extensive ray tracing support, and broad AI framework integration, that have come to define the premium GPU market. The GPU war is no longer fought solely on the terrain of silicon. The modern battlefield is one of software, ecosystems, and developer loyalty. And on this battlefield, Nvidia has built an impenetrable fortress, a competitive advantage so deep and so powerful that it has become known throughout the industry as the CUDA moat. So, what is CUDA? In simple terms, CUDA, which stands for Compute Unified Device Architecture, is a software platform and programming model that unlocks the immense parallel processing power of Nvidia GPUs for general-purpose computing. Before CUDA, GPUs were specialized processors designed for one thing: rendering graphics. CUDA changed that. It gave developers using standard programming languages like C++ and Python a way to run their complex calculations across the thousands of small cores inside a GPU, all at the same time. The genesis of this moat was a visionary, long-term bet on what CEO Jensen Huang calls a $0 billion market. Back in the mid-2000s, while AMD and its newly acquired ATI division were focused on the graphics war, Nvidia noticed something unusual. University researchers and scientists were buying their GeForce gaming cards not to play games, but to run scientific simulations. They were hacking the graphics pipeline to perform complex calculations. Instead of ignoring this niche use case, Nvidia leaned in. They launched CUDA in 2006, creating the tools to make this process easier and more powerful. This decision created a powerful, self-reinforcing flywheel effect. The CUDA software toolkit was, and still is, free to download and use. But there was a catch. It only runs on Nvidia hardware. First, Nvidia invested heavily in the ecosystem, creating specialized libraries like CUDA for deep learning and a suite of powerful tools to help developers optimize their code. Second, millions of developers, scientists, and data analysts built their applications, their machine learning models, and their entire research careers on top of the CUDA platform. An entire generation of AI talent learned to code on Nvidia's architecture. Third, this created a massive, irreplaceable library of CUDA-optimized software, making it the de facto global standard for artificial intelligence and high-performance computing, HPC. The result is that today, for any university, startup, or Fortune 500 company working in AI, it is far easier, cheaper, and faster to buy Nvidia's expensive, high-margin hardware than it is to rewrite decades of cumulative software development and retrain their entire staff to work on a competitor's platform. This is the CUDA moat, a barrier to entry built not of silicon, but of code. This long-term strategy is precisely why Nvidia now utterly dominates the AI and data center markets, which have become the most profitable and strategically important segments in the entire semiconductor industry. Nvidia's GPUs are the undisputed engines of the AI revolution, from training the massive language models that power services like ChatGPT to running the inference workloads in sprawling data centers across the globe. This dominance has driven Nvidia's revenue and market capitalization to astronomical heights, which in turn provides even more funding to pour back into R&D, widening the CUDA moat with every passing quarter. A recent development has shown just how strategically Nvidia wields this advantage. In late 2025, Nvidia announced a historic partnership with its old rival, Intel. This collaboration is a strategic masterstroke designed to completely marginalize AMD in the enterprise AI space. The enterprise data center market, the world of corporate servers and cloud infrastructure, is built on the foundation of Intel's x86 CPU architecture. This is the very market where AMD has had its greatest success, with its EPYC server CPUs winning significant market share from Intel. Nvidia's AI dominance, meanwhile, is built on CUDA. To use Nvidia's powerful AI accelerators, enterprise customers had to pair them with a CPU, and increasingly, the best choice for that CPU was AMD's EPYC. The new partnership short-circuits this dynamic. The deal will see Intel build custom x86 CPUs that are tightly integrated with Nvidia's GPUs using Nvidia's proprietary high-speed interconnect, NVLink. This creates a new, optimized, and officially sanctioned standard, a CUDA-first, x86-compatible architecture. This move effectively boxes in AMD. It removes the primary reason for an enterprise customer to choose an AMD EPYC processor for their AI workloads. Why mix and match when you can now buy a fully integrated, validated, and performance-optimized CPU-GPU system from the two undisputed market leaders? It is a brilliant, ruthless move that turns AMD's greatest strength, its leadership in the data center CPU market, into a non-factor in the most lucrative and fastest-growing part of that very market.